Thank you, Yassine, and thank you, Alyssa. How's everybody doing today? And thank you very much for joining us. We're going to speak today on a topic that is very timely with all of the disruption that's happening in the world right now regarding retail and generally most industries receiving some stress around getting paid as the virus keeps business sort of hampered. And then we have a sort of a second trend of companies filing insurance claims for business interruption, which aren't being paid by the carriers, which is creating a second level of stress on many of these leveraged companies. So the purpose of this presentation today is to help you as a CFO or credit manager or credit officer for your company sell safely into customers that are highly risky. What I'm going to do now is I'm going to go into sort of a little bit of background as to why we're here. Now, put options are not just for retail companies. There are many companies in many different sectors, such as metals, such as retail, such as any type of aerospace, any type of company that's doing into automotive. Bankruptcy protection is very hot topic right now. So as we know, retail stores are closing rapidly and retailers are filing for bankruptcy protection left and right. We have over 20 this year. You as a supplier, you purchase and rely on credit insurance or your factoring company or your bank for an asset-based line of credit to gain guidance on the debtors that you're selling to. The problem that we're seeing is that credit insurance has very little or no appetite for certain risks and certain sectors, and coverage was removed very early, leaving you exposed. But your organization still wants to sell the goods to the customer, and you want to expand and dominate shelf space, so to speak. And the put option does provide an opportunity to achieve this. Put options are generally for highly distressed debtors. So you don't want to look at a put option for a Target or a Walmart or an Amazon. You want to look at a put option for a Macy's, a Bed Bath & Beyond. Maybe you're looking at AK Steel or US Steel. These types of companies that are more distressed is where the put option is valuable. There are two types of put options. There are pre-petition put options and post-petition put options. The most common is a pre-petition put option. The thinking here is that you have credit insurance. Your credit insurance carrier has canceled coverage on some debtors that you still wish to do business with, even though those debtors are distressed. So in this case, a pre-petition put option would be the put option that you purchase before an entity files for Chapter 11. Payment on the put option for pre-petition would be triggered by a Chapter 11 filing. Normally on these put options, there would be no co-insurance. It would usually be 100% payout. So if you were to purchase $1 million put option, you would receive $1 million back, provided that your customer went bankrupt and that your claim was allowed. With these types of put options, investors are either in place or investors must be found to create the hedge for this put option. Now for the post-petition, this is a very limited market, but this is also timely as well because you have a lot of companies such as Tuesday Morning, JCPenney's, Ascendia Retail, and you have quite a few others. I can go down the list all day. But post-petition is when you purchase an option to protect yourself against the liquidation of the entity that's already filed for a Chapter 11. So you are under a debtor in possession agreement and you're shipping goods, and you may find yourself purchasing this put option because there's a high risk of liquidation. Many companies think that a DIP solution is secure, but it's not. As we see with JCPenney's, which has received so much news. Even though they made a deal to avert bankruptcy, they're back in court today because the judge is concerned that the pace of the deal is going too slow. And there are shareholders and there are creditors who have a voice who basically are saying, no deal is a done deal at this point. So we may still find ourselves in a situation where a company like JCPenney's actually does liquidate and is being forced to do so by the weight of their obligations. So there is usually a co-insurance on a post-petition put option. Many either banks or hedge funds that write the put options will pay out 80% or 70%, depending on the level of recovery that they would expect to get. And for the post-petition put options, the investors are already in place. So this is sort of the smart money playing where they know they can benefit. They don't need to go and find investors to create a hedge for these. These are already spoken for. The investors are already lined up because they know what they're getting involved in, and they're basically ready to put their money behind the put option for this.